Hello to all traders watching. My name is Pedro Souza and I am a FX harmonic trader. Today I'm going to be talking about a very important subject for all traders: money and risk management. I'll try to sum it up nicely for you, but there's quite a few things that we need to go through. So first of all, I am showing you an example of a potential trade so you can visualize the levels where the entry should be, what kind of target profit we are looking at, where the stop loss is, and in order for you to understand that one of the most important aspects of trading is the risk to reward. You want to lose small and win big, at least most times. So you can see there's a potential trade, you can see the entry, the sell, you can see where the profit take should be, and you can see the size of the stop, and you can see the reward. So you can see you're risking small and potentially winning at least twice or three times bigger. This would be at least 1 to 3 risk to reward. That is the kind of trade you want to take. This is the kind of entry that you are looking to trade, because this absolutely maximizes your chances of being profitable in the long run. It is very important when you set your trades, you can see a reward that is much bigger than the risk that you are taking. It is important to manage your risk effectively, keeping your losses small and your profits as big as possible. You do that by sticking to the size of your stop loss. You don't move the stop loss. You always honor the stop loss, and you stick as well to your target profits. This is very important. If before the trade you have planned for it, so if you have a trading plan, you should always stick to that trading plan. So sticking to the trading plan includes the risk, the reward, the stop, and so on and so forth. So you don't want to change any of these things, and I will explain to you in a minute why this is so important. Now, consistency is one of the most important aspects of trading as well. So by keeping the same variables, so you're keeping the same stop loss, target profit, reward to risk, position size, you are skewing the probabilities in your favor. Now I'm going to show you why that is like that. If you look at the example of a normal distribution of probabilities, and you don't need to be a mathematician or a statistician, a distribution of probabilities is just a chart that shows where which ones are the events that are most likely to happen. And you can see in this example, in the throw of the dice, you can see that number 7 is the number that has got the most probabilities of getting hit. So you can see the combinations for number 7 are the ones more likely to happen. So assuming all probabilities and variables are the same, if you are trading and you are keeping to the same variables, in the end of the day, we can assume trading as having a normal distribution, and that means that if you stick to the same variables, you are going to have a positive outcome in the long run. You can see that if you have a normal distribution of results where your losses and wins are distributed over a curve, but you stick with the same risk reward, what happens is you go through a series of losses and you will lose, in this example, $1,000 on each trade, amounting to 5,000, and then the wins are 3 times bigger because of that risk to reward, and you make 15,000. So you win 15,000, you lost 5,000, you turn up a profit of 10,000, and that is because you are skewing the probabilities in your favor. So if you stick to the same variables, you expect a normal distribution, even if you don't have an edge. Now, people who are trading with me, we trade harmonics, we do have an edge. But even if you didn't have an edge and your win to loss ratio is not 6 to 4, it could be even 3 to 7, and you can still turn a profit if you use the risk to reward in your favor. Remember, when you are going through a series of losses, you need to have a sound money management to withstand the time where the market is not going in your favor. Maybe the market conditions have changed. Maybe the market is ranging and your strategy is better for trending markets. That is the case with harmonics. That will make a huge difference. You need to survive the time where you're going through the market is not doing what you are most used to and what your system is designed to. So you're going to have to survive that time. In order to survive that time, you will have to adapt and you have to stick to your risk and money management rules. And you can see by looking at this table that if you're risking 1% per trade, it's going to take the market 100 times to prove you wrong before wiping out your account completely. If you stay in the long run, the market is not going to stay in conditions that are not favorable to your particular trading style. But your account has to survive in order for you to get to that stage. Once you are on the other side, then you will be okay to continue trading. But if you have no account, you will have no chance continue trading. So preserving your capital, number one rule of this game. Staying in for the long run, you'll have more chances to trade and many better opportunities. This is all I've got for you in this short video. There will be more videos coming. Keep following us on our Discord channel. You can also check the YouTube channel. Lots of videos there for you to learn. And until I see you next time, have a good trading week. Goodbye.